Josh, did you miss potting?
I did. I missed our friendship. I feel like half of our conversations are on the air.
For everybody here.
So I wonder what's going on with Mike. I hope we have a podcast episode scheduled soon. So, all right, boys, this is truly a treat. I'm so excited that you're here. You're staying in New York for how long?
Go home tomorrow.
2
Got
days.
in yesterday.
Yeah.
You got here yesterday.
Got in yesterday.
Okay. What were the rounds? What'd you do?
I did CNBC this morning at 6 o'clock, which was fun.
Is that pre-squawk? What is that?
No, it was pre-squawk. It was squawk. It was a Joe.
Okay.
Joe.
Oh, yeah.
Right
Okay.
there. 3
Were you
blocks that
super
way.
bearish?
No, I don't know what it was. I wasn't super bearish though. you know it's
All right.
RIA guys. Did some Yahoo yesterday, and then
Hang
going to the
tight.
stock twists
John's
tonight.
not here, but somebody's got to make this thing work.
What? It is.
No.
You guys miss Josh?
Unless something's wrong with this. No. Yeah, don't worry. Don't get nervous here.
You're not getting nervous. I should hear it.
Nicole, stop shaking. You're fine.
Nicole,
be
stop.
nervous.
Cold sweat.
You're
Nicole,
good.
stop trembling.
Your job is safe.
There you go.
Queen.
You see, Queen? All right, guys. Nicole's birthday this week, so I don't know if you brought any gifts or anything like that. All right, so you did squawk. What else?
Did some Yahoo Finance yesterday as well, and then
Okay.
we've got the Stock Twits CMT Summer Social. As soon as this is over, which will be Jay Woods and all the
Sonu, what about you? They let you on TV?
No, it's just him.
Just this guy?
Yeah. It's just him.
You get him ready for it though.
Yeah.
You prepare
Exactly.
him.
I said, Soda, what should I say?
Where's
Tells
the
me.
Stock Twits event? I wish I could go.
It's down by the New York Stock Exchange, somewhere
Stone
on
Street.
Stone Street
Yeah,
at a
if
sports
Jay
bar.
Woods is organizing it, it's not going to be very far from the exchange.
No, it's not,
Right.
and it's at a sports bar down there. It'll
Shout
be
to
a blast.
Stock Twitch.
Yeah.
Shout to the MTA. All right. So listen, I'm super excited about this. The last time we talked officially was October. Came to Omaha.
Yeah.
Had a great time there. And you guys
Can I jump
are
in for a second, Josh?
Yeah, please.
you had steak twice in one day when you went to
for
Omaha.
three-
Oh,
It was a 3
times.
times. It was 3 times.
think it was
Oh,
3
I was
times.
trying to. Okay, it was 3. No, yeah, he did.
Wow.
He's smiling. Look at him.
I had 3 meetings at 3 different steakhouses all in the same day, and I ate at all 3 of them. One of them was
Legend.
just supposed to be a drink, but I'm like,
Legend.
but like I'm having a drink, so
You're in
let's
Omaha,
do
why
like a
not?
fillet.
Yeah.
All right. Omaha's cool that way.
Yeah.
You guys have a lot of great restaurants. But what I wanted to say was it was really awesome being on your show, and now the tables have turned. We have you on our show.
Thank
so
you.
now we get to ask the questions, and you guys
Uh-oh.
get to show us how smart you are. Carson's pretty big in Omaha. Like 1 out of every 3 people I met worked at Carson at this event. It was a FPA event or whatever. So, what's it like being when you're there? Because I know you guys. Do you live in?
I'm in Chicago.
You're in Chicago. So when you guys are there, you're there in town. What's it like being like, we're the Carson people?
It's mostly steak. Yeah,
That's
but
more steaks.
more steaks. But no, it's nice to be around everyone because we work remotely.
Yeah.
So it's nice to be around the
Is there a
proverbial
giant
water
building?
cooler, basically.
It's a giant building.
Yeah.
Yes.
I didn't get to go visit in person. I was supposed to, but I just couldn't. So I'll come next time I come. I'll come visit.
Yeah. Carson's a big RIA.
Yeah.
42 billion. We're in about 41 or 42 states, depending
42
on.
billion.
We're signing some people like as we speak.
How many
we're getting
advisors?
there. Approximately 500.
500.
Have you spoken to all of them?
Jeez.
Oh,
Sonu
goodness.
probably has.
Maybe about 350 or so. There are a lot of new ones.
Yeah.
But it's
That's
two.
true. A lot
But
of
it's
new ones,
two
yeah.
firms. So half my understanding, the way it was explained to me by a Carson person, half the building is Carson Platform, which are like advisors that have their own doing business as RIA, but then they use Carson for support and tech and compliance and research. And then the other half are people that are actually Carson reps at the Carson corporate RIA. Yes?
Yeah, that's Carson Wealth, Carson Group.
Carson
Technically
Group,
a part of
Carson Wealth.
Carson Group. Yeah.
Okay. All right. Very cool. All right. So let's get on the way, guys. How we looking? We good?
Yeah.
Because I don't know if you saw, but we have a ton of charts. We have a lot to get to with these young men.
You can do it at the same time.
Okay. 2 seconds coming in. Let me just color card.
Hit me.
Good, John. All right, here we go. Episode 199.
Today's show is brought to you by Russell Investments. In today's markets, you can't afford to have a portfolio stuck on autopilot. Set it and forget it won't cut it, as it could mean missing out on attractive opportunities or taking more risk than you realize.
At Russell Investments, innovation is in their DNA, and their cutting-edge product lineup is designed to meet the needs of the modern investor. Russell Investments' new actively managed ETFs offer every investor control and confidence, providing access to top-tier managers and combining return potential with the lower cost of an ETF. No surprise tax bills at the end of the year.
In developing these products, they've drawn on the consulting and manager research expertise which they have cultivated since their founding in 1936. Today, they canvass the globe to find top-performing strategies and world-class managers and bring those insights straight to you through innovative multi-asset portfolios built around their unique investment goals.
Take control of your investing life and add Russell Investment ETFs to your portfolio today.
To purchase their ETFs, ask your financial advisor or visit their website to access self-directed brokerages.
Paid for by Russell Investments. Full disclosures in podcast description. Oh my God. Ladies and gentlemen, welcome to one of the best investing podcasts in the world. Not quite the only great investing podcast in the world. Well,
What one of the best?
One of the best.
You lost your fastball. You
No.
went to Italy. You lost your fastball.
no, we're in the presence of podcast greatness.
That's true.
So I pulled it back a little bit. All right. Ladies and gentlemen, we are very fortunate to have two special guests here in the studio. You've met Ryan Detrick before, returning champion to the show. Ryan is the chief market strategist at Carson Group, an advisory firm with more than $42 billion in assets. Prior to Carson, Ryan spent, that the pointing is my move. Ryan spent more than a decade at Schaefer's Investment Research and 6 years at LPL Financial. Ryan also hosts a top investing podcast, Facts versus Feelings, alongside Carson Group colleague Sonu Varghese. Welcome to the show.
Thank you.
February 24, last time I was here, and lot to discuss.
Yes,
It was
for
fun.
sure.
Yeah.
For sure. Sonu, you're a VP and global macro strategist at Carson, 20 years experience. Before joining Carson, partner and director of research at Convex Capital Management, where you co-managed portfolios, advised clients, and led the research team. Welcome to the show.
Thank you.
Can we do this? Can we talk about the shirts for a minute?
Yes.
Yes.
All right. So you have Michael Batnick on a Hawaiian shirt, and Ryan, you have downtown Josh
Yes.
Brown.
Yeah.
Did you just have those lying around, or like?
Always. Yeah.
I just said to him about a month ago, so we need to do something for your show. And I know you guys like your Hawaiian shirts, and one thing led to another. And like I said, I mean, we're staying at a hotel about 3-4 blocks away, and I had two people stop me. They thought I was Josh Brown. I said, no, I'm not Josh Brown. I don't wear my own shirt. But no, it's I mean, listen, we're huge fans of you guys. This is a huge honor. I mean, everything you've done in this industry, and it means a lot. And it's just I worry we're going to run out of time in a hurry with the four of us, but it's going to be fun. Whatever we talk about, whatever we talk about,
we're going to make it work. And you guys have one of the best shows, obviously, should go without saying. And I think there's probably a ton of overlap. A lot of our listeners probably listen to you guys. A lot of your listeners probably listen to us. So this will be very enjoyable for the audience, hopefully. And look, it's a great time to have this conversation, kind of high level conversation, economy, markets, because I can't remember a weirder situation than the one that we're in right now. But I don't even want to set the stage and give you my take, because I really want to focus on, people have heard enough from me. I want to focus on what you guys think is happening right now. We're halfway through the year. The S&P is having a just below average, but still pretty good year. Tech is on fire once again. The tariff thing never went away, but also didn't seem to become a huge issue. Earnings are growing. The economy seems okay. Fed isn't doing anything. And this is just kind of like a status quo. The same stasis we've been in for a long time. What do you think is happening?
I think the market's got momentum. And despite and despite all the noise of tariffs and Fed policy, we could talk about all that. But, there's no sign of a recession yet. I think that's the reality, and that's always good for profit growth.
Yeah. What's good is that you said that a year ago and 6 months ago, and you've been right.
Yeah.
And a lot of people said there were plenty of signs of recession, and maybe there still are. But your larger point is it's not happening yet.
Right, which doesn't mean the economy is growing at 3%. When we came into this year, I think that was the expectation for a lot of people. Oh, the economy is growing at 3%. We were in the camp that, wait, 2023, 2024, the economy grew at near 3%. That's not going to continue. Maybe closer to 1.5%, 2% or so. But that's not recessionary.
Yeah. Is it good enough?
I think it's more than good enough for profits, especially when you talk about large cap tech.
What do you think the economy's growing at right now?
1.5%.
Okay.
Yeah.
And is that above expectations? Weren't people saying flat growth this year? Or is it below? I don't even know where the consensus was.
Remember GDP Now?
Yeah.
The Atlanta Fed tracker. Holy mackerel, did that get bearish in a hurry?
Yeah, and now it's bullish. Now it's at 2.5, something like that.
But it's some of the surprises are now to the downside is the thing that you'll hear people say recently. And I don't follow it closely enough to have a strong opinion on whether or not it is or it isn't. But do you agree with that take that some of the downside surprises are becoming increasingly noteworthy?
It's slowing. That's why if you just look at aggregate income growth, right, which is a product of payroll growth, which is non-farm payrolls, wage growth and hours. Hours is soft, wage growth is slowing, payroll growth is slowing. So aggregate income growth is growing around 3% or so. So think of that as nominal GDP growth.
Okay.
Yeah, but so you say all the time, like the consumer is the economy. 70% of the economy is consumer spending. But for the stock market, which is being led by the AI megatrend, which is being powered by Amazon's balance sheet and Microsoft's balance sheet, maybe consumer income is less relevant to power the stock market today. Is that fair?
I think to an extent, yes. But ultimately, the economy is where profits come from at an aggregate level, right? But then, with the big hyperscalers, you have CapEx spending, and one business's or even one person's spending is another business's revenue and profits, right? So that's, I think, what's happening.
So we're going to do this a little bit later, but I kind of can't not say that we really need to retire this phrase, the consumer, because it's descriptive of literally no one. We really have this two-speed, K-shaped economy, whatever you want to call it. You have one consumer that effectively is driven completely by what the stock market just did in the last week. And you have another consumer that right now is showing all signs of throwing in the towel. And we can talk more about like what those signs are. But the bottom, I think 20% of households by income have now completely stopped traveling. Like they're not even on the radar anymore. That same bottom 20% are making huge switches in their discretionary spending at retail stores. It's showing up in credit card data. It's showing up in, so like, is that the consumer? Or is the consumer like Jeff Bezos' nephew who's got, just for fun, 300,000 shares of Amazon. And every passing hour, his net worth increases by $17 million. Like, who's the consumer?
Well, for the purposes of this discussion, the stock market discussion, it's the latter, obviously.
Right. So that's one of the hardest things, I think. When I said this is one of the weirdest times ever, I really think there's a huge portion of the American public that is struggling, but none of that struggle is reflected at all in the stock market. It doesn't seem to matter to earnings, doesn't seem to matter to valuations, doesn't at all seem to matter to the money that's being spent on AI and defense tech and all these other things. And so it's like, well, yeah, the consumer is the most important thing in the economy, but who's the consumer? What is the consumer? You got thoughts on this?
Yeah, I'll take a little different angle on it. 3 months ago today was the lows, right? 63 trading days ago was the lows in April.
I was so bearish.
Yeah, well, yeah. And what was everybody telling us? I mean, recession. So like Sonu just said, the economy's growing, a little below trend, but it's not a recession. That's why I think we've had this huge comeback. And I just looked, so today we're going to be up 25% in 3 months. Only 5 other times in history have we gained 25% in a 3-month period. You ready for these? Off the lows in 75, off the lows in 82, off the lows in 2009, off the lows in 2020, and then in early 1999 in there. 1 year later, higher every time, 22% average. Every single time,
different
up double digits. Yeah, different this time. I know 99 was at the end. I get it. That's just for the people who like to point that out. But Josh, it's something we kick around on our team all the time because the consumer's pretty solid. But like you said, it's the upper incomes that are moving it. But as stewards of assets, our job is to understand, are we going into a recession? What's being priced in? What's not? You bring up good points, but at the same time, it's why we've been overweight equities.
Well,
we still think people are still buying stuff that move the economy. It's a tough discussion.
So Sonu just said, like, one person's spending is another person's income. For me, the question is that bottom 2 deciles that we talked about who have completely walked off the game board at this point, and they're just paying their bills and trying to survive. By the way, these are the people that just nominated a almost full-on communist as the mayoral candidate for the Democratic Party in New York City. So this is who. So that group of people, how much bigger can that cohort grow to where their lack of spending starts to actually impact the income of the Fortune 500, the S&P 500?
No. Savita had
at no point in time will they ever matter
to certain companies and sectors and industries, probably,
but not to the overall market.
Savita had this data point. I think it was her. The bottom 20% of spenders account for like 15 basis points of consumption for the S&P 500 or Fortune 500 companies. They
don't even show up.
Not talking about in real life. In the stock market, purely, these people matter. For the stock market, they do not.
Even generally, I think if you just look at overall aggregate consumption, a lot of it comes from the upper, let's say, quintiles, right? 40 to 100 or even 60 to 100 in terms of income.
Yeah,
quintiles.
so that's not new. That's not new. Right. That's always that way.
Mm-hmm.
The distribution might accordion in and out, but just generally speaking, here's what's new. A situation where the lower income household is still struggling with inflation, now going on 4 years, while everyone else, especially people who have big assets in the stock market or own private businesses or whatever, the valuations for their assets grow to the point where they don't even feel inflation anymore, and they're probably causing it.
All right, let's talk about the stock market.
Okay.
So there's this incredible chart. I'm sure you guys have seen it. Do you know who's this Duality Research?
Not sure, but they share some good stuff.
Okay, so this is pure eye candy. So for people that are listening, here's what we're looking at. They have a chart of the S&P 500, and at the bottom in April, they show the relative performance on a different axis, the relative performance of each sector compared to the S&P 500 since the bottom. And what we're showing is what's happening is exactly what you want to see in a bull market bounce. So what's lagging dramatically? The most defensive names. Healthcare, nobody wants. Staples and utilities, nobody wants. What is leading us higher since the bottom? And if you were to update it today, probably looks even better in terms of technology, communication services, and where I said it probably looks even better, industrials and financials are on fire. So if you tune out everything and you are merely looking inside the market under the hood and you didn't know anything about the economy or tariffs or inflation or the Fed or anything, you would say this is about as technically healthy as a bull market could possibly be. The sectors that you want leading are doing just that.
I'll chime in. I mean, a couple hours at the CMT thing, we're going to talk about that because what's leading are the cyclical areas. And we get the worries and concerns that everybody knows. When you see industrials, financials, communication services, and tech making new weekly all-time highs last week, that's the market's way of saying maybe the second half of this year is going to be okay. And maybe the economy is going to do a little bit better than we think. And, the one thing, and then the
market's not wrong, you're wrong.
Yeah, well, we've all learned that the hard way.
Yeah. This is all one thing, though. This is AI.
Mm-hmm.
Those leading sectors.
Industrials and banks are AI?
Industrials are 100% rallying on AI.
Banks?
Like Caterpillar is a great example of this. Mm-hmm. All the defense stocks, everything is the AI tailwind for spending. They have to physically move Earth to build the facilities that they're building.
But the financials, that's not AI.
Yeah, it is. The return of IPOs, the return of M&A, booming bond markets, booming stock markets, wealth management, blah, blah, blah. It all comes back to the AI theme. It is single-handedly powering this current bull market. The wave. Look, every bull market's powered by an innovation wave. Like we're not breaking new ground saying that. Whether it's electricity or automobiles or the telephone, it's always something.
You're right. Okay, here's another great one. This is from Sentiment Trader. Ryan, I know you love this stuff. Yeah. So the S&P 500, after the percentage of cyclical sub-industry groups with a positive 1-year return that cycled from less than 20% to greater than 80%. So this is another way of saying there's wide breadth thrusts. If you look at the green arrows and you look at forward returns, like by definition, this happens at bottoms. From oversold bearish to overbought bullish, on a 12-month forward basis, this is the good stuff.
So I'll just say this. I thought last week's podcast was the best ever. Was there something different about it? I forget.
Yes, I wasn't
No, you had Joe on, Joe Fahmy, and Joe pointed out this wide breadth thrust. You guys have talked about it all over the place. And that's what it is, where you have these short-term, extremely oversold, to short-term, extremely overbought, and that's that flush out, right? If everyone's thinking alike, somebody isn't thinking. General Patton, I love that one. And that's what we've seen. And we've seen that, Michael, at every major bottom. We continue to see that, and it's just market psychology.
You really like that data point about all of the periods of time in history where we've had this kind of a thrust and a race to new highs.
It's the most reliable bottom signal.
I can just chime in here.
Yeah.
And Sonu, you can jump in a second. But April 9th, right, we gained 9.5% of the S&P 500. 98% of all the volume was higher that day. So I got data back to 1980 from Bloomberg. That's like a top 5 day. All those days were the bottom. That was it. And then I said, what we really want to see is what we were talking about over Carson. Want to see another strong day sometime soon. April 21st, we saw another day with like 95% of all stocks
I actually
up.
remember that.
Yeah, and when you have back-to-back super duper strong days like that within 2 weeks of each other, the lows are in. We were on record, at least I was. Maybe Sony was, but I was on record. The lows are in. Like, this is it. Like, unless something really bad happens, the lows are in. And then we had the best May since 1990, one of the best Junes of all time. And now here we are making new highs. Maybe today, by the time we're done talking, and I think that's just how history plays out.
I want to ask you guys, there is a universe in which Trump does not rescind the tariffs or push the deadline out or whatever he did. I know it's some combination of the two. There's a universe where he says, you know what? I don't really care about the stock market that much this time. I'm a second-term president. It is what it is. I have bigger problems to fix, and the stock market will take care of itself. And we are, at this point, will have already implemented those original 145%, 110%, taxes on penguins. I don't even
50%.
The fucking details like escape me now. But like, there is a universe where he sticks to his guns because Lutnick loses a few fights in front of him and Navarro wins. You know what I mean? Like, he likes to watch them battle it out, and then he says, "I'm going with you." So there's a universe where Navarro wins and doesn't get put into a capsule and shot into the sun.
So more black eyes in the White House.
I mean, Navarro around more over the last 2 days.
But you're not getting that first bread thrust, is my point, on April 9th. You're definitely not getting the one on the 21st. In that universe, we're still in a 20% bear market, and maybe worse. Because those tariffs, had they been implemented in those amounts, would have absolutely thrown the housing market off a cliff, would have absolutely forced the Fed by now to probably be hiking, would have taken the U.S. auto industry and cracked it in half, as implemented. So the bearishness around those tariffs wasn't totally crazy. Things just didn't play out that way. You had to take the position that Trump's not really going to do this, which
I think he reversed them, right? Temporarily.
But I'm talking now, picture a world where he didn't. What things would look much different today than how they turned out.
I think the market's bet maybe is that it's not going to happen.
Definitely.
That is the bet. Right?
I would say definitely.
Right.
Okay.
But I think ultimately where the impact is, and we talked about this all the time, the biggest impact of the tariffs is really it keeps pushing the Fed further and further away from a rate cut.
Okay.
Right.
That's the biggest takeaway from all this.
And that's not good for the housing market. We talked about, the duality of consumers. I think there's a duality across who owns homes at a 3.5% mortgage rate, effective mortgage rate, versus those that don't have a home.
So Trump 2 days ago tweeted 50% tariffs on copper. And then today, I demand the Fed cut interest rates. These two things are a little bit incompatible with each other. Are you guys still monitoring the tariff front? Or at this point, is it not really a big factor in what you're telling clients?
You kind of have to, right? With the tariff thing, I mean, just talking about portfolios as well, one thing we've talked about over the last couple of years really is that you need to diversify diversifiers as well. So beyond bonds, do things like managed futures. And we saw the impact of that 2 days ago when he said 50% tariffs on copper. Copper jumped. All these managed futures, funds, whatever they are, all of them have a big position in copper too. So that did well. And that's why we say, okay, you need to have some exposure to supply shocks, things like this as well.
One of the other things that the market has going for it is you saw an insane amount of rotation in the second quarter. So the Mag 7 are still below their highs. Bespoke has this great table showing that investors are selling winners and buying losers so far in July. So far in July, the 20 worst stocks in the first half of the year are the best performing, followed by the 50 worst, followed by the 100 worst. And it looks the exact opposite when you're talking about the 20 best stocks, they're being sold, the 50 best, the 100 best.
This is just rebalancing, right? ETFs.
I don't know, but I don't think the ETFs are rebalancing into the junk.
Yeah, they are.
What are you talking about?
They're rules based.
to rebalance out of quality growth and into bullshit? No, it's not. Stop.
Well, it depends on the ETF.
Stop. All right, here's another chart. Second quarter rebounds saw low quality being king. So these are a lot of Goldman Sachs baskets. So the meme stock basket was up 44%. You think they're not rebalancing into memes. Quantum computing was up 68%. So you're seeing this massive rotation inside the market, which is, Ralph Acampora said it was the lifeblood of a bull market.
Yep. You know, look at ARK. All right, we had Kathy on Facts versus Feelings on April 23rd, and the comments that we got, people weren't real happy.
You
with
almost
her.
have to turn them off.
Well, yeah, I mean, not towards he and I, but towards the guest. And I said to him, I said, oh my goodness.
Yeah.
ARK's about to go bonkers. It's up 51% since she joined our
because
podcast. The negativity toward Kathy, they were so mad at the stuff that was lagging. And now you look at what's happened since those lows, and it's just been like the beach ball, the ball under the water, you let go and it goes. But you're right, the lifeblood of a bull market is rotation, and we're seeing it. I'll tell you, Bitcoin's hitting all-time highs. Like I think the second we're doing this. Yeah. We're not really allowed to get too into Bitcoin. I'll just say this. Is anyone even talking about it? Is it? I was on CNBC. I did a couple of media things. Everyone's talking about NVIDIA 4 trillion. That's a real popular thing. I get it. But nobody's talking about Bitcoin. I mean, we all remember 2021 when it was going crazy, and you had day trader Dave, banging his hammer. I remember he looked out his window and he saw a deer, so he bought deer, the stock, and it went up. That was crazy times. You talk about sentiment now. Well, it did work. I mean, but like sentiment now, there's some optimism maybe, but we know the hedge funds missed it.
Do you get bothered when you see like the lowest quality stocks and the Cathie Wood stuff? Like when you see that take over market leadership, which I don't think it is, by the way, but fine. Like let's say it's starting to do better. Mm-hmm. When you guys look at markets, do you say, all right, this is a sign that we might want to get more cautious, or do you just like look through it?
I'd look through it, I guess. When I see industrials, financials also along with the party.
So I'm that way.
That's kind of where
I could accept that there's a lot of stupid shit going on.
We're at all-time highs.
It depends on how long it goes on for too, right?
But then I'm like, oh, wait a minute. Boeing is rallying. And for Boeing to rally, you need like 3 acts of God, basically. I'm the same way as you. Like I can acknowledge, like, all right, there's really dumb stuff happening all around us, but also the fundamental underpinning is not all junk. There's like a lot of quality rallies.
I want to hit rewind on something we said a little bit ago, but when we came into this year, what did we know? Well, we had back-to-back 20% years. We knew this. The first quarter after 20% years, usually not that great. The first quarter in a post-election year is like one of the weakest quarters in a 4-year presidential cycle. Oh, by the way, the last 20 years, the first quarter has been the worst. We were on record saying there could be a 12 to 15% peak-to-trough correction sometime during this year prior to the first half. And
I'm on record saying that every year, by the way.
Well, you're right. I mean, I hear you there, but we can't. So we said that, and then it happens, right? And everyone freaks out, and we get why, the emotions of everything. But it's just incredible how it happened again, and everyone got all bared up, and now you realize the economy's not as bad as they said, and things aren't as bad.
Are you surprised though at the strength of the rebound?
You have to be. I mean, you guys talked about it on Anal Spirits, quickest ever from down 15 to back. But at the same time, look at credit markets. I mean, in April, one of the reasons I was fairly optimistic, I said junk bonds would be getting crushed if this monster
I was saying that all of April. Thank you.
I was listening to you. But like, then people kind of ignored it. They said, "Oh, look at this, look at that." It's like, no, high yield bonds high yield spreads are hanging in there. Trust me, they spiked because we're in a darn near bear market. But those were those little clues, and like you said, Josh, and then Taco, whatever you want to call it, happened on April 9th. And then it was off to the races.
You know what a really good tell in hindsight, which I certainly didn't pick up on at the time, but now that I look at it and I say like, oh, people should have been talking more about this. Like foreign country stocks, they called his bluff better than the. So the U.S. stock market had a conniption. It sold off 19.5%. Granted, the comeback's been amazing, but like overseas, stocks were rallying. They were fucking laughing. Like foreign investors, they got the whole game really easily, and we didn't. So
I'm going to set this up and turn it to Sonu. So we manage about $5 billion. You hear us talking, like we manage real money along with talking about these things. We've been overweight the U.S. for 2 years, heavily overweight the U.S. People didn't like it, but it's worked. And where we were at the start of this year,
I've been heavily overweight for 2 years too. So it's cool.
Yeah, you're right. Cool. For a while, you're just on vacation. You're allowed to be.
Fair.
But I mean, what do we think about international, Sonu?
No, look, coming into this year, like I said, we were pedal to the metal on equity, overweight, and U.S. equities. And then, we were thinking about, look, one tailwind international stocks have had is the dollar going down.
Yeah.
right? Especially for just US dollar based investors. And we're like, okay, and you think about why does the dollar go up or down generally? I mean, not over the next day or two. It's expectations, relative expectations of growth. Coming into this year, people are expecting 3% growth in the US, maybe 0% growth in Europe. That's changed now. Especially even before Liberation Day in March, you're talking about German fiscal spending, things like that. That's sort of like, okay, maybe something is changing here. Let's move to a neutral weight, US versus international. That's what we did, back in February and March. And we saw, expectations for US
so
growth
you guys
coming down.
trimmed US and added to international
Even
in
while
February,
being,
March.
overweight.
Yeah,
equities.
March 3rd, we did some pretty big trades. And
Okay.
we did that so before all the trouble started. And
Okay.
obviously
So,
worked
so
out.
you guys aren't like you're likely, as you should, to look through a lot of the silliness because an all-time high, there's always tons of silliness. Not easy to point that out. What about something like this? This week we saw Bank of America and Goldman both hit the S&P with upgrades after downgrades earlier in the year. Does that say, all right, maybe we're due for a little bit of a pause, or is that too cute? You don't think about that sort of stuff.
I mean, it kind of reflects momentum, right? The market's going up, everyone's moving up targets. Market goes down, everyone's moving down targets. But sentiment, going back to something Ryan just said, the sentiment doesn't seem very overextended.
It's not. So,
You can't react to the strategists in real time because all they're doing is marking their own calls to where the market just went. David Costin at Goldman, this was the big news today, raised his year-end S&P 500 target to 6,600, which would be 6% from the latest closing level.
That's where we are.
Lifted his 3-month and 12-month price targets to 6,400 and 6,900, nice, respectively. Previous 2025 target was 6,100, which he set in mid-May during the trade war. So like most of the strategists on the street had to lower their targets in April when it looked like we were going to have a man-made, self-induced recession. And then when that came off the table, it was only a matter of time before they had to chase the market higher. Definitely, my comment to the listeners and the viewers is definitely do not try to align what you're doing in your account with year-end price targets.
Well, so Costin also said, while narrow breadth often signals the risk of larger than average drawdowns, like we just talked about,
Breadth isn't
I'm not
narrow.
sure where this narrow
Yeah.
breadth argument's coming from because
Huh?
I'm simply not seeing that one.
Here's
Yeah.
how I would describe the sentiment. And sentiment is very hard to describe as one sentiment because who are you talking about? Maybe a rally of disbelief. So, for example, this is from the Daily Chart Book, which I get a lot of my stuff from. Shout out to them. The estimated short interest, is that estimated? Short interest for the top 10 stocks, for the top 10% most shorted stocks, is rising. It's up and to the right. There is a lot of fighting the tape, and these are probably the junky names, and this is probably
I was
fueling.
gonna say, do we know, like, if we had to guess what's in here?
I'm making this up. Peloton and a lot of those sort of
The small growth,
Yeah.
mid-cap growth names.
But also maybe like the Modernas and the,
sure. Yeah, and
right?
Moderna's
Yeah.
rallying hard.
Yeah, the
So-
the Zooms.
Right. I don't think that this is further fueling fire to the fact that this is exactly what you want to see in terms of bull market, both technically and on the sentiment side. I'm not seeing a lot of excess just in terms of like enthusiasm, everybody in, no, don't worry about risk. There's still a dose of disbelief.
I travel the country all the time and do this and talk to financial advisors and their clients. Then you do Q&A. I've never in the last this year been asked, hey, it's really good out there. How high is this going to go? You're always asked
No
what's
one.
wrong
Yeah,
with it.
that's such a great point.
What's bad out there? Look how bad this is. And I get it
When
because
does
you're
it
worried.
end?
But at the same time, like the short interest is one example, and we kind of hinted at it. Like hedge funds, from what I see and hear, they've been fighting this thing up the whole time. And this is maybe another way of showing that. They just keep increasing their shorts. And
We
in a
know
way,
they
it's
were
self-fulfilling.
net sellers throughout the course of the spring.
Right.
Like they didn't. It's really retail that jumped in with buy orders in size
Yeah. Congratulations.
before any other category of professional.
Yeah.
So that's notable. All right, you guys have your own proprietary leading economic indicator. Index, I guess would be the way to put it. You have your own. So what does that mean? You looked at the way it's typically done and you changed the components or the basket of things that you look at for your own indicator.
This was about 12 years ago when he created this. This is at my previous shop. We looked at the conference boards, LEI, and we were like, wait, this doesn't quite capture, what the U.S. economy
What was
is.
wrong? What was wrong with
It
it?
was mostly geared towards the industrial manufacturing sector rather than consumption.
Which is shrinking.
Yeah. And this was, 2013, right? And at that time, we were like, and then every now and then they change the indicators and they, do whatever it is they do. So you're like, we need to create our own. Right?
Okay.
And we said we want something that, and it's mostly for a sanity check, right? I'm not a believer in like indicator macro, like there is a silver bullet indicator, and I certainly don't think our LEI is
It's
a silver
magazine
bullet.
covers. I'll save you some
There
time.
you go. Yes. Like especially The Economist.
Yeah.
So, but yeah, no, we created something that hopefully captures the U.S. economy, and because every day we get different indicators. Today we get claims, you get ISM PMIs, and then you're like going from one to another. Like, oh, this is bad. That's good. This is really
Oh,
bad.
that's the worst game
Right.
that the media
Right.
the media plays the game
Right.
because the news comes out and they're like have to cover it.
Right.
So
And-
it's like, oh, markets are red because let's find an indicator that was worse than expected.
The yield
Right.
curve is inverted, all of that, right?
Yeah.
So what was that? April 1st, 2 years ago?
April
Then-
Fool's Day of 22 is when the yield curve inverted. I've called that the greatest April Fool's joke of all time.
Yeah.
So we put together the index just for the sanity check. Of like, okay, let's put, what we think are, it's not a data mining exercise. I mean, we could do that, but 200 indicators together. No, this just has about 25 indicators
What's
that
the
captures
goal?
the
What's
US.
the goal? To capture a more real snapshot of the state of the economy at a given moment.
Exactly.
Because you can't wait for GDP data. It's on a
No.
big lag. And by then, nobody cares.
No, exactly. Like the
Okay.
famous Semblus chart,
Yeah.
right, which shows that, the market bottoms before GDP. First of all, you don't even get GDP. That's much later, and then it gets revised.
Right. So that's not useful
Yeah.
for investing.
No.
Okay. So what are you doing with your LEI?
We
And
trans-
what is it telling us about the state of the country?
It tells us whether the average indicator, so let's say representative of the economy, is that growing on trend, above trend, or below trend? And right now it's telling us the economic growth is growing below trend, but not recessionary.
Okay.
And we have 30 of these for 30 different countries around, 29. We stopped doing Russia a few years
Okay.
back.
Yeah.
But we have 29 of these, and each of them are tailored towards those respective economies. In the US, it's more about consumption. In China, more about investment. Germany, South Korea, it's more about export.
Oh, so you
things like that.
create a different basket and weight things differently depending on the country.
Yes.
So what is the US? Same store sales at McDonald's? Like what are the things that are going into your
It's more
concert
aggregate
tickets?
It's more aggregate indicators that we have a history for. So it's
Okay.
got things like retail sales, food services, auto sales, housing starts, building permits. Yeah, standard indicators. Like I said, it's a sanity check. Put everything together. What's the picture?
So if you saw this really roll, what would you guys do?
We would start getting cautious. And this goes back to the fact, even back in 2022, when everyone was calling for a recession, well, even 2023 for that matter, we didn't see a recession at that time. We weren't, we were overweight equities. And we were like, I don't think there's a recession coming, which is not to say it'd be correct, but the odds are in favor of no
look
recession.
at this. So this, I don't know what you mean by rollover. I guess it would have to cross below.
Let's say
what is this?
net-
What is the Z-score?
A Z-score is, how far above or below trend is
So
the
what
average
would you
indicator
need
growing.
to see for you to say, to Michael's point, all right, things have now materially changed and we are tipping into recession?
Just to put a number around,
Yeah, put a
negative
number on it.
0.5, negative 0.6.
So
Once
we're
you
not-
get down there, we're
so we're
nowhere
obviously
close to
not
that.
there.
No, nowhere close to that.
And you could have a false alarm
Yeah.
if you dip into that. It's not a guaranteed recession. It's just, I guess you back tested it and usually it's pretty bad.
Right. And what you're essentially seeing is sort of a back test anyway, right? Like we weren't
course.
doing this in 2001 or 2006 for that
So
matter.
I'll chime in here. So in early 2023, we wrote our outlook. The second line of our outlook said we don't see a recession and we could hit new highs this year. Now, we didn't hit new highs in 23, but rallied a lot. And a lot of this was the work Sonu did, which went contrary to just about everybody else, saying the economy is better than you think here. And literally today, we just released our mid-year outlook, and we talk about a lot of these concepts. And the reality is, I'll just give Sonu a pat on the back. I mean, there's Neil and Sonu and a few others that really look at this economic data differently than so many other people. They don't just look at, oh my goodness, manufacturing ISM sub 45, yield curves inverted. The end is here because it has to be, because every time it's done that the last 6 times. But if you actually peel back that onion like he does, I don't even know what's in this thing. I just listen to it and say, hey, how's it look, Sonu? And he tells me. I look at other stuff. But the reality is it's worked. And
Sonu,
it still looks okay.
I love that you're giving him his flowers, by the way. When did you realize that the old way of thinking about the economy with all the gobbledygook that Ryan mentioned is no longer the playbook?
It was originally when we were thinking about how do we want to model the economy and, do it from the perspective, I need to manage real money here, right? Think about markets, right? And what's the connection between markets and the economy? Profits, right? So when you think about the aggregate economy, you range, like you take a sectoral balance approach, right? You got households, businesses, the government too. Back in 22, 23, the other part of it was there was a lot of government spending coming down the line. right? The IRA and CHIPS Act, Bipartisan Infrastructure Act, the American Recovery Act, that hadn't finished putting all its funds out. So all of that is happening. And we thought, wait a minute, that's good for corporate profits, right? So the idea was, how do we capture, a snapshot of the economy that can sort of tell us what's happening to aggregate profit growth?
Do you use stock prices at all?
Yes, it's
Okay.
in there.
How important are they?
They're quite important, but in this, I can tell you, it's about 5% of the index.
So I'm a wealth effect
But
truther.
he does all the equity part anyways, right?
So you would have gotten a false signal had you just gone by the performance of the stock market in 22.
Yeah.
You would have been all over the recession call, and I kind of was. Like late 22, I don't predict the economy, but if I had to guess, I would have said recession for 23.
Yeah.
Thank God we didn't have one.
And the odds were higher. Even if you go back and look at the chart, it was inching towards negative 0.4.
I'm looking at it right now. It was as close as it gets without crossing fully over.
And at that time, I was saying, the odds of a recession about 35%, or, it's higher.
But again, here's the thing that nobody can know. If you're just looking at your leading economic indicator, without a doubt, 3 months later at that trend, you're in a recession.
Yeah.
None of us can know that ChatGPT was just released.
Right.
Yep.
And it has the potential to unleash what looks like it's going to be $5 trillion worth of spending inside of 24 months. Nobody could possibly know that.
So it's like more fiscal stimulus.
It's better than fiscal stimulus because it's almost entirely driven by the private sector and did not require interest rate cuts. The entirety of the AI boom so far is happening with higher than normal interest rates, with restrictive policy in place.
Yeah.
And look, you could not have said that in 99. The Fed had a huge emergency rate cut in 98, the summer of 98. And I know that fueled the next 500 IPOs because I was there. You don't have that this time.
So I know Sonu's going to jump on that. Hold that for 1 second. So this is kind of how we work together. So he's got what we're showing on the screen. But remember the end of that bear market?
Cop?
Yeah, exactly. That October 22
I'm
low,
the bad
right?
cop. I'm the
About
global
a
macro
20
strategist, right?
Yeah, about a 25% bear market ended in the middle of October 22. Your average non-recessionary bear market's 24.5%. So we're in that range where you can have a bear market without a recession. As everybody knows, when you have a recession, it's about 35% bear market. That Friday, we had that CPI, I think it was CPI Tuesday or Wednesday. So it was high, right? Remember inflation. The market gapped down like 2% at the open. By the close on that day, I think it was like October 12th or 14th, one or the other, closed up 2%. So you had a 5% swing intraday.
It's wild.
And that's the stuff I look at, and I'm like, oh my goodness, like I shared it literally that day. So that's how lows happen. Literally, that's how lows happen.
That was the low.
That was the low. We didn't know it at the time.
It was October
12th or 14th,
October
whatever
12th?
that CPI
Something
was.
like that.
We were on the show that day. Remember we drove into the city? We were in the car when the inflation number
It
came
was
out.
inflation, CPI.
We were on the show that day with Pisani.
It felt like the end
and
of the
Kyla.
world. It felt like the end of the world that morning.
Oh, you know what
and
we
then
were
you
talking
closed
about
higher.
that week? The VIX
Yeah, that's
had
right,
this
too.
insane move, and then it completely reversed itself. And I think that was the conversation. And Pisani was like kind of schooling everyone, like, you guys don't understand. The VIX is about the next 30 days. It's not about 6 months from now. It's literally people pricing in the risk that they think is going to happen tomorrow. And then when tomorrow comes, it unwinds. That's why the risk mean reverts or oscillates or whatever. So I do remember that period of time. I just think we got really lucky at the end of 22.
We did.
And into 23.
If we didn't get ChatGPT, I think there would have been a recession eventually. Because we say there wasn't a recession, but there was a lot of parts of the economy, specifically with the stock market.
Had a
Silicon
recession.
Valley, 100% recession. There was a website that updated real-time layoffs. Real estate still in a recession. So there were areas of the economy, not overall, that absolutely got fucked up by higher interest rates.
I mean,
Commercial real estate still.
You'd still argue, like, over the last 6 months, the tech sector has lost about 10,000 jobs.
There's no more software jobs being added.
So, and
but not because of the economy, because of innovation. And it's a little bit of a, like, in other words, Microsoft didn't just say 9,000 layoffs because times are hard or because profits are hurting. They said it because they can.
And they went on a hiring spree. If you look at the numbers back in 2021.
They all did. They overhired.
Yeah, they overhired. And now I think they're still recovering from that.
I think that's right. I wanted to, hang on a sec.
You want to talk about Vegas?
I want to talk about things that are not traditional indicators, but kind of force you to pay attention. I wanted to ask you guys your thoughts when we talk about the consumer. What's the most important behavior of the consumer to be thinking about or keeping an eye on? Because I think it's travel, and then as a subsector of travel, I think it's gambling. So, what do you think about that?
Travel, full service meals, restaurants.
Okay,
and that's been actually flat. Once
for
you
me, it's
adjust for
casino.
inflation.
For me, it's Vegas.
Yeah.
I feel like Vegas is like the throbbing tip of the whole like. Is that the right? It's probably
throbbing tip.
Probably the wrong way of phrasing it.
I don't know, Josh.
I think it's like where the real nerve center of like appetite, consumer appetite.
I like nerve center
to
better.
do shit.
And you mean like gambling as an entertainment, not as opposed to a professional?
Like specifically, let's go to Vegas.
Right.
I feel like that only is in good times. It is the most dispensable of potential trips you could take. Also, corporate spending in Vegas. Obviously, that's the first thing to go. I guess we're not going to do the Vegas junket this year because we just missed earnings last quarter. Like for me, that's a big one to watch. They are. Here's why I bring this up, guys. We're going to talk about inflation. Vegas is basically committing suicide, by suicide by price. So this is. I've read 20 of the same article in the last week. This is the DailyMail.com. Las Vegas high prices putting off potential tourists. According to new visitor figures, tourist numbers have fallen every month this year, with 6.5% fewer visitors than in 2024. International arrivals at Harry Reid Airport down 8.7% in May versus May of 2024. A visitor recently shared her shock after she was charged $26 for a bottle of Fiji water. A British magician was left outraged. How dare you? $74 for 2 drinks at the Sphere. The buffet at Bellagio is like $175.
It's always been this way. Nonsensical.
No, it's worse than ever, and notably, and it's stopping people from going.
Stocks are on fire.
Some of this is international tourists.
A lot of it is.
Like, but they're not coming anymore. I mean, if you just look at tourism from abroad, which actually shows up as a service export, that's gone down.
Yeah,
travel and tourism from abroad. Yeah.
What do you think of this as like an indicator to just look at the way people are? Because when you go to Vegas, when you do that, you're really spending on things that nobody on earth needs. That's like to me, that's the pinnacle of like the consumer is doing great.
So
Vegas is not doing great right now.
Yeah, the first week of April went out west, which is obviously a fun family trip. Went to Bryce Canyon and Zion National
Way better
Park.
trip than Las Vegas.
Well, we went to Vegas for a couple of days too.
Okay.
I'm worried about my 14-year-old, by the way. The way his eyes lit up in Vegas, like they
you got
like,
one of those.
threw like $100 on a couple parlays, and they lost, of course, on the last game. I said, well, that's gambling. That's why we don't do it. But I didn't think it was as crowded as I remember because I was in Vegas the year before for a work thing with Carson, and I was looking around thinking, this is interesting. It's like spring break, and Vegas truly didn't feel as crowded. And then some of the softening that Sonu talks about, but I guess that's the key thing: is it recessionary or is it softening? And then, like Mike, you just said, the stocks are doing pretty good all of a sudden, but over the past year they haven't done as well.
In a recession, they're giving away their rooms just to get you to.
And they're not doing that now. You're right.
Can I show you some charts?
Yeah, let's do it.
All right. This is a 1-year price performance of Caesars. You wouldn't buy this chart. You would buy this for what? For a capital loss? You want to harvest?
It looks like it might have
in a month or two.
Doesn't look terrible.
I'm with you.
Next.
Yeah.
Ryan, how do you feel?
A little messy. Yeah.
Okay.
Not much there.
Here's MGM. Another horrible downtrend. Very obvious downtrend. They continue to sell lower highs. Here's Wynn. This one looks good. They're in the process of building what's going to be the next hot.
Dude, Wynn looks great.
Yeah, they're building something crazy.
Is the buffet better?
Wynn looks great.
No, they're building a brand new resort, like the first one that's opened in a long time, and people are excited about it.
Yeah.
Also, but there's like Chinese exposure mixed in here,
Right.
and it's really hard to disentangle Vegas from China. Here's another LVS, Las Vegas Sands. This is China. This is not Las Vegas,
That's not
even
a
though
bad
it's
chart.
called Las Vegas Sands.
I would argue that there was absolutely softness. There's no doubt about it. Vegas and excess cash and money to burn, that should end it.
And high prices, flushing
no doubt. There's
people
no doubt
that would normally be playing.
That's absolutely true.
And even at an aggregate level, you're just talking about yes, it is aggregate, but you look at wage growth, right? Wage growth 3 years ago was growing about 5-6%. Now it's come down to 3%.
Yeah, it's different.
And people act differently as a result.
No doubt.
I totally agree with you.
But we heard from Delta this morning.
Right.
which had a lot of softness in the first quarter, a lot of foreign travelers pulling back. Okay. And Delta stocks got destroyed. Delta got crushed. Well, today it's having one of its best days of the last 5 years. It's up 13%. They reported a record quarterly revenue for the second quarter. Record.
This is a big day for Delta.
They said their high margin business is doing
High
well,
margin-
which I imagine is business class things
That's
like
This
the
is
that.
my
high-end
point,
consumer.
though. This is how we open the show.
Yeah.
When we talk about a K-shaped economy, you basically so in the back of the plane they can't sell seats. In the front of the plane, they're putting in golden toilets. That's the economy right now.
Yep.
I mean, so
That's absolutely right.
they're United just built first class suites. So now when you're in first class, you have a door. Like open the door to come talk to me. Otherwise, get out. This is my private suite on a United flight.
You know, it's weird. Emirates and Singapore have had that for a long time. It's kind of curious that we're only just getting that.
Dude, we looked at the price to fly Emirates to Italy.
From here?
To 2x the price of a first class flight on an American
Was it
airline.
$9,000
It
more?
was 10, it would have been 10 or 11
Do
grand.
you have to go to the Middle East and then back up to Italy for that?
No, the flight direct to Europe.
Okay.
Those are the sickest planes ever with all the amenity, anything you could ever want, which is kind of wasted on me because I would rather just do drugs and fall asleep.
But so this is the story of the economy, and you're not seeing it in the stock market because we're at all-time highs.
But it's to consumers,
But
is
you're
my
seeing
point.
you're seeing it in surveys, and you're seeing it in elections. People are pissed off.
And there are prices that are going up. I mean, overall aggregate inflation, you can talk about the issues with how official shelter and all that is, measured. But you look at electricity and gas prices, something I've been tracking recently. Electricity, gas prices, utilities, basically, it's up 6% year over year.
Oh, wow.
14.5% last 3 months annualized. So you talk about wallets, especially when wage
Yeah,
growth
it's
is going
nuts.
lower from 6% to 3%. A lot of people may not even get wage increases, but your utility bills are rising at like a 10% annualized rate.
Did car insurance cool off? Remember how pissed off people rightly were about that?
It's cooled off, I mean, but I think it's still,
Yeah.
it's still high.
Well, let me tell you this. I got a notification before we started the show that my jet ski insurance went down a decent amount.
There you go.
That's because of how good you are as a rider.
Yeah, exactly. No, but that's
They've been
notable because
watching my social media.
that prices dropped like fairly dramatically for me, and I didn't do anything.
Let's talk about household balance sheets. All right, we have a chart for this.
That's the throbbing tip.
It sure is. What's the? Did I say? I don't say that. I feel like I said
Stop.
throbbing.
Let's just leave it alone.
Okay. What's the message of this?
In aggregate, household balance sheets are in good shape. And for two reasons. Home prices have gone up, especially over the last 5-6 years. And stock prices have gone up. But that gets to, okay, who owns the stuff, right? At the upper income
So you said
quintiles.
in aggregate.
In
'cause
aggregate, yes.
That's the point.
That's the thing, right?
Okay.
And the other side of it is that debt, as a percentage, this is as a percentage of disposable income, that's relatively low compared to where we were even in 2019. And remember, 2019 was the end of a big deleveraging cycle. So that's actually a good spot to compare it to. So
Why are you pulling these other periods of time?
just to look at what the top of the cycle is, right? Just to compare it. Like
Can you
the peak of the cycle.
can you walk us through this? As of Q1 2025, you're showing the asset layer of the household, which is above the 0% line. Things that are assets.
Mhm.
So real estate would be their houses.
Yep.
Consumer durables with cars.
Cars,
Okay.
Yeah.
Corporate equities,
stocks,
debt securities, would be treasuries, muni bonds.
Yep.
And then I guess cash and business ownership.
Yep.
And that's at a record high.
Yep.
That's
It's 833% of disposable income. Again, this is
Is that
aggregate.
good?
That sounds really good.
Compared to before the pandemic, 2019 Q4, it was 769%.
Nice.
Okay, so liabilities are what is the minus 93% signify?
It's just 93. It's just negative liability being negative. So 93% of disposable income is, mortgage debt is mostly that, and then consumer credit.
I'll put it like this. So you got that negative 93. That's as a percent of disposable income. Everybody here is 37 trillion. We walk by the debt clock, by the way, just randomly. It's wherever it is, block or two away. And you hear all that, and 1.2 trillion in credit card debt, and another couple trillion here, a couple trillion there. But as a percent of denominator blindness, we've all talked about, you guys talk about all the time, denominator blindness. that's the numerator. You got to look at the denominator,
Which
right?
is what?
There's
The size of the economy?
or
of the
just
asset?
equity.
In
the
this case,
asset. There's
disposable income.
disposable income in this case, but people are worth a lot more. And we get it. This conversation we've been having for the past 45 minutes, it's not perfect, but this is why the stock market's hitting all-time highs. This is why at the start of 23, Sonu was sharing this chart saying, listen, if we had a recession in 23, it might not be as bad as they're telling us because of this, because people were still worth a decent amount of money, all things considered, especially but relative to 25 years ago at the end of 1999. Because again, we've got more debt overall because every 3 months when that Fed data comes out and it's a new record in credit card debt, media go crazy, but they just seem to ignore all the wealth that was created more so
that's
along
the
the way.
spending
That's how it
that
works.
fuels the wealth creation.
Very
the problem
true.
is it's not balanced amongst everyone.
And they're not going to Vegas.
Let's
enough
do these
anymore.
charts: rising home prices and stock prices boosting households.
Similar to what we just talked about.
Another way of looking at the same idea.
Over time. And I think this gets to something
What
you
is
were
this up?
talking about.
What is the 215%?
Yeah, equities, right? Equity stocks as an asset, as a percentage of disposable income is 250%. Home
Okay.
prices as a percentage of disposable income, again, in aggregate, 215%. But this gets to, what could damage household balance sheets? And then you look at this, well, if home prices come down or if stock prices come down. I think that's why I think the stock market is really tied to the economy right now through this balance sheet
I've been
picture.
screaming this.
Well, Josh always talks about this. You know what that line is? That line represents asset-backed loans, right? These people don't need to sell their securities to buy anything. They'll just borrow against it at a very low interest rate.
Because then you don't have to pay the taxes
Right.
and capital gains either.
Right, that's the story.
A lot of the way we used to think about the economy was from a time where you had to sell something to buy something else.
Not anymore.
We have an entire generation of people who have done securities-based loans, and they've had their cake and eaten it too. They've kept their portfolio intact, and they've bought the vacation home utilizing very low interest loans that are being backed by a combination of Apple, Nvidia, and U.S. Treasury bonds.
Yeah, thank you, Jensen Wang. I will buy a second house and borrow against my portfolio.
This gets back to also what you were talking about, like, the more of Navarro that we see, if things start going down, it can go down only so much.
But you know what?
Right?
He was on CNBC on Monday morning. I said,
He's been coming out.
Not going to be a good day. The market was
Did all
down
right.
1%.
Right.
Give me a break.
Send him back to the dark side of the moon. Daniel, can you please put up chart 15? Let's do forward earnings. I want to make sure we get to all this stuff because you guys have awesome charts.
This is remarkable.
Tell us what's going on here.
Well, this is like the name suggests, forward earnings on the S&P 500 12 months out, $281 a share, all-time record.
Who could have imagined?
Who could have imagined that? Honestly,
Not
nobody
me.
was 3 months ago.
This is what is this? This is the consensus Wall Street expectation for S&P 500 earnings in the next 12 months.
Yeah.
Exactly.
All right, so trading just under 24 times forward. It's not cheap, but
tell
why should
people
it be?
where that number was 2 years ago.
Where was it?
Wow.
2 years ago and June of 230.
240?
Yeah.
230?
230, yeah.
Okay.
Yeah.
This is incredible.
It is.
Can we all agree it's AI?
It is. And in 2026, expect to be up 13%. That's about where we were at the
But-
start of the year.
But like
I
all
mean,
kidding
that's-
aside,
yeah.
this is not coming from pharmaceuticals, home
you're right.
builders.
It's all AI.
It's all AI, all of it. So great, no complaints. But I'm just saying, let's all acknowledge what's going on here. Okay,
But the neat one's the next chart too, profit margins. Literally last week, profit margins just hit a new high this cycle. Which
It's also forward-looking.
All we hear,
AI.
we hear is profit margins have one way to go, and that's down. For 3 years now, we've been hearing that.
Yeah.
And I call this the dual tailwind to a bull market. When you have these two things going up, stocks are going to follow. Keep it real simple.
And
that's what
multiples
we're
will
seeing.
expand.
Yeah.
So profit margins now 13.7%.
The highest
Which
this
is-
cycle. Yeah.
Which right. So people are like looking at the valuation. It's like, yeah, no, it's not. The market's not cheap. But guess what? Companies have never made as much money as they're making right now.
Right. A
Made
story
like
of,
took home.
operating leverage, right? As sales go up, they're expanding margins.
If we're in the middle of an AI revolution or the early stages or who knows where we are, why would you expect multiples to be cheap?
Right.
You wouldn't.
Bubble chart. Do you still hear this as a bubble? You hear this from a lot of people? I don't.
No, not as much, but frothy, I guess. And this is something
I hear
Sonu just
froth
updated
yeah.
recently.
Yeah, I'm breaking down. You can break down S&P 500 returns or anything really into how much is coming from multiple growth, how much is coming from EPS growth and dividends, and then you break down EPS or earnings growth into sales and margin growth. And over the since the end of 2019, last 5.5 years, the equity market's up 112% total, out of which 49, close to 50% has come from sales growth, which is just the economy growing. But 20 percentage points has come from margin expansion.
Right.
Right.
How much for multiple expansion?
26 percentage points. Multiple
So
expansion.
a quarter of the rally can be explained by people just paying up for stocks.
Yep.
Another quarter can be explained by profit margins growing.
Yeah.
And then what was the remainder?
And then sales growth,
Sales growth.
and dividends too. Dividends about 17 percentage points, right?
So is that a healthy mix?
yeah, I would say
Yeah.
so.
What do you
Yeah.
think?
Very healthy.
Yep.
Absolutely.
I would say
Well,
so.
like, what would you
Right.
want it to be? No no multiple expansion? Why?
Right.
Right.
And the comparison is relative to 2019. So we weren't talking about, oh, this is the bottom of a recession, anything like that. If you go back to 2009 and plot it, yes, you will see multiple expansion because multiples are like 8 or 9 or 10 or something like that, right? But this is from 2019, and it's been a story of profitability.
So, all right, Trump tweeted something from the multiverse today. There are so many twists and turns within this one
Yes.
Truth Social post that it's almost incredible. Like I don't know how to get on this level where any of this makes sense, honestly. Let me just read it. Tech stocks, industrial stocks, and NASDAQ hit all-time record highs. Crypto through the roof. NVIDIA is up 47% since Trump tariffs. USA is taking in hundreds of billions of dollars in tariffs. Country is now back. A great credit. Fed should rapidly lower rate to reflect this strength. USA should be at the top of the list. No inflation.
Dude, get on his level.
So in other words, NVIDIA is up 47%. The country has never been doing better. Hurry up and cut rates.
Yeah,
I
reflect
think
the strength.
that's actually
Reflect the strength.
Reflect the strength.
Yeah, what's
that actually reveals a lot. He thinks of the U.S. as even the Treasury market as a credit, product.
Sonu, reflect the strength.
just reflect the strength.
Yeah. So the better the economy is doing, the better stocks are doing, the better home prices are doing. Is like
The lower interest rate should be.
lower interest rate.
Yeah, sure.
Can I say one really positive thing about stuff like this? I think the market just doesn't care anymore.
Mhm.
It really has to be something big, like a press conference or something. His tweets really can't change people's mind about what they're doing on any given day. It really has to rise to the level of like, all right, here's new policy, and I'm about to sign it into law. Then you get the market's attention. And I actually like that because the alternative is like every day, why is my portfolio down 4%? Oh, he tweeted whatever. So I kind of like that. It's just at this point, it's a punchline right at the beginning and nobody really reacts to it.
Yeah.
Think that's where we are?
Oh,
The
he did
VIX,
say-
VIX is sub 20. I think so. I mean,
Dude, VIX
yeah.
is at 15. It's
Yeah,
unbelievable.
yeah,
It's
right.
on the mat.
It's
Oh, he did move markets the last couple of days,
Yeah.
like the Brazilian market and the copper. So he's still got some of that power.
All right. We want to hit any more of these?
It's up to these guys. I'm
Guys,
full.
what else in here did we not
we
get
can
to?
just jump ahead. Just remember one of the stock stuff, or the one that's called the sweet spot. We can
Yeah,
go to
let's do
one.
that.
So, this year we're up about 5-6% at the middle of the year. So it's kind of one of those times. Okay, let's take a look at that. There have been the worst second halves of years usually are after the worst first halves, 2000, 2001, 2002, 2008, and then 2022. And then there's 87, which are up a lot and you come back, and 76 is up a lot and you come back, and somewhere in the early 80s, up a lot and come back. So this is kind of right there. The average first half is up about 4.5%. This
Okay.
one, again, 5 or 6. So I look at all the times you're up between 5 and 10% at the middle of the year. What happens next? And, well, as you can see on the screen, I'll tell the listeners, S&P's up 13 out of 15 times the rest of the year with above average return. So that's, just I call them these what it is type of studies. Just we're in the sweet spot is what I call it. The next chart is when you're higher, May and June. May and June usually aren't that great. We know they were higher this year, substantially higher. Again, what happens next? The final 6 months up 15 out of 16 times with an average return. I believe it's right around, 8, almost 9%, almost double the average second half of a year. So you just stack those two little nuggets, and I get it. I do these on social media and it's a sample size of this, sample size of that. That's fine. I understand. But when you stack all these,
like for example, on
Yeah.
the May and June one, how many instances of
well,
that
16.
do you have?
There's 16. There's 16 of
It's
them.
not
Like I
nothing.
joke as well. If there were
It's
more,
not
I'd use
5.
them. It's not 5. But I'm just saying when you stack all these different studies that I look at and share, and Sonu looks at and shares, it is said for a while the stock market wants to go higher. I have a CMT behind my name, Chartered Market Technician, disciple of John Murphy. It's all about the market. What's the market telling us? Are we listening? And to me, the action we're seeing is saying we are in a
Bullish.
bull market, and
We're
it's
in a
still
bull
going
market.
to go higher.
So the
Yeah.
reason why these things are worth paying attention to, like when the market's up May, June, it's not voodoo. because what we're saying by saying that has meaning and that you found these 16 other episodes of that, we're saying that like human behavior is the constant here.
Yeah.
And for whatever reason, if the market has a really powerful summer, it probably does lend itself to people chasing in the next 6 months of the year.
Of course it does.
Right. So, but that's our point, is that buying begets even more
It's
buying.
FOMO. Come on, people.
Yeah. So it's a lot of career risk. It's a lot of people that are behind. They have to catch up, or people won't give them money for next year. There's a lot of that going on. So that's what you're saying when you look at this data.
And, maybe one more. I know we're getting near the end. Year 3 of the bull market. I sent that chart, and you guys talk about this. I talk about it. But year 3s of bull markets are usually choppy.
Let me say, where is that?
Usually frustrating. Down a couple more. Usually choppy, usually frustrating. But usually the bull market doesn't end. I found 5. Well, not I found. There are 5 bull markets last 50 years that made it this far. The average before the bull market was over was 8. The shortest was 5 years. So once, I call it's like a cruise ship. Once a bull market gets moving like a cruise ship, they're hard to stop. They're really hard to turn around. Yeah, maybe a 100-year pandemic, maybe some crazy stuff with tariffs. But the reality is year 3 is that catch your breath moment. Like Sonu and I talk about this a lot on Facts versus Feelings, our podcast with our Carson advisors. Expect some choppiness, expect some trouble during year 3. We had it. I think it's in the rear view mirror now, and now I think we're past that indigestion period, and years 4 and 5 tend to be strong. And these are just things we look at when you stack it all together, with new highs on advanced decline lines and credit markets still hanging in there. Those are the 2 things I follow. And people say, what do you look at? I say advanced decline lines and the credit markets. If those 2 are worrisome, you asked Sonu earlier, with his LEI, if I see credit spreads breaking above where they were in 2022 and I see advanced decline lines breaking down, then that's when I'm thinking, okay, this is going to get a lot worse.
We're not seeing these things.
We're not seeing it at all, Josh. And then the other stuff we just said suggests, again, to be overweight equities, have a little international exposure, have some EM. We do have a little bit of gold. I'm going to get into that, but just in case bad stuff happens, we still think, this is a great time for diversified portfolio going forward.
Ladies and gentlemen, Ryan Detrick, Sonu Varghese, thank you guys.
Thank you.
You guys are awesome. This is fun.
Oh, this is
good.
That's awesome.
All right.
No, this
Probably
is
a
fun.
few more F-bombs on our show than your show, but I think, I think you guys are 2 of the best to do it. So we're big fans of yours. We didn't have shirts made up.
Next time.
I was away. Otherwise I would have gotten to it. But thank you guys so much for being on the show. We end the show these days by asking people what they're most looking forward to. And it could be anything. Be personal, professional, you tell me. Let's start with you. What are you most looking forward to?
Not talking about tariffs again.
Come on.
no. Actually, I have a trip with the family out to the same neck of the woods.
Where are you going?
Bryce Canyons.
I say Vegas.
Arches.
Vegas,
They're gonna
Vegas.
fly back to Chicago from Vegas. So,
Okay.
maybe catch a show or circus. I have 8-year-old twins.
Beautiful.
They've never been there.
Bryce
So-
Canyon, you ride horses through that canyon, right? I think I did that as a kid.
I did bikes. You can buy
Bikes.
bikes, horses, yeah.
No,
E-bikes,
dragons.
e-bikes,
You ride
e-bikes.
dragons,
Yeah.
All right. Dude, that's amazing. Congratulations. Congratulations.
Yeah.
What about you? What are you looking forward
I
to?
love doing this market stuff with him all day, but like from a personal point of view, both my boys play football. And once you get to July, it gets serious. My one son is a freshman, and they're at a pretty good high school. So I'm looking forward to watching my boys play some sports, specifically
How big are they?
football.
You're a big dude.
I'm big. I hope they both grow more. I mean, my let's see, my freshman's about 5'8", 5'9", and my 7th grader, he needs to grow a little bit. So
Okay.
yeah,
What position do they play?
Let's see. My sophomore is a safety, and then the 7th grader is wide receiver / cornerback.
How do they get those positions? Is that where the coach says you would be great here, or did they gravitate toward that and
Both
want
of
to do
them
that?
gravitated toward it, I would say.
Okay.
Yeah, one, he loves being. He loves
You
safety. He loves it.
you played ball in high school.
Well, I played golf and basketball in high school, so not football.
Okay.
Yeah.
Why are you afraid of getting hit?
Yeah, I was afraid I'd got
All
no
right.
problems with my head
Hey,
already.
you didn't want to go to the Black Sabbath tribute show, Ozzy's
When
farewell
I
show?
watched that, let's talk about that for a second. I was sick, I wasn't there, but Steven Tyler truly stole that show. I mean, who
Dude,
would have thought
right?
that? The way Steven Tyler came out there and did his thing, and that was awesome. As an old school metalhead, Black Sabbath started it all for me in '97 at Ozfest
I know,
at
I know.
Polaris Amphitheater. When Ozzy didn't show up, they literally tore the place down and burned it up. You can Google it and find it. I said, "Oh, I like that," and I've been into that music ever since. And Ozzy's one of the best in Black
Did you
Sabbath.
and I
That was
go
cool.
to the? Did you and I see AC/DC with Axl
I
Rose
don't.
as the lead singer?
Well, you want to answer this one?
I was there.
I don't know if you were there because you left really
Josh
early.
left.
You left
No,
early.
I didn't leave that.
You left
Yes, you
early.
did.
You
Yes,
left
you
early,
did.
Josh.
Yes, you did.
Because
Not that.
Fahmy got us backstage. Chris Jericho's walking around.
No,
Axl
no,
Rose.
no,
Fahmy knows
but I was there
everybody.
for the show.
Joe got us downstairs under the garden.
Yeah,
And
yeah,
Josh
under the
left.
garden.
Josh
That's
left.
what not
It's a different
backstage.
show. You're talking about Motley Crue.
No, it was
Motley
AC/DC. It was Axl Rose singing for AC/DC.
I was at that entire show. I remember the encore.
Okay, then you left before we went in the
I
back
didn't
with
go.
Joe.
No, of course. I don't wait to go
I
back.
got
I'm a
you.
celebrity myself. I don't do
hear you.
backstage.
Yeah.
You think I do fucking meet and greets? Are you kidding me? All right.
Yeah.
I was at that show with you,
Yeah,
though.
we had a blast. That was
I think that was-
2016. 2016 is when
I
that was.
tell people about that.
That was
First of all,
awesome.
people have to Google it. They don't believe me that it happened.
Yeah, Axl sang
They're like,
AC/DC.
what do you mean Axl Rose and AC/DC?
Oh
I'm
yeah,
like,
we saw that.
Oh, we were there.
I'm like, I was there. You could trust me. It happened. And people will still Google it.
I think Charlie was there too. I don't know. A bunch of us were there. Yeah.
That was great.
Who else did you think sounded good at the Ozzy thing?
Oh, jeez.
I was super impressed by
I
all
mean,
these guys.
just Ozzy on a throne. The guy could barely stand up
know.
singing "Crazy Train." I mean, I thought it was cool. And Bill Ward, the drummer, 78 years old. 78 years old. He's out there doing the drumming with the shirt off and everything. It was just really, really.
I
emotional,
liked how
really
much
cool.
buy-in they got. Everybody was there.
Mhm.
Like
Yes, everyone.
I thought that was super cool. Like
I mean,
Pantera was there.
Metallica didn't have a show for that. They were right before Metallica came out to show show props. It was
I thought
really
that was cool.
Yeah.
All right, my thing I'm looking forward to is getting back on East Coast time. I was up at 2 a.m. today for the day. I'm
Oh,
still
no.
going. I'm still going. So I'll be asleep in an hour. All right, guys, this has been amazing. We appreciate you so much. Let's tell people where they can follow your continued insights and research. What's the best way to follow Sonu and Ryan?
Yeah, easiest is Facts versus Feelings or podcast or
All right,
favorite
that's
podcasts,
easy.
and at Ryan Detrick, Twitter.
Okay.
A lot of people follow
At
us there.
Sonu S. Varghese, yeah.
All right, awesome.
And then carsongroup.com/research is our blog.
Okay,
as
very
well.
good. That's
There you go.
ritholtzwealth.com.
There you go.
All right.
You guys are the best.
Hey, I want to thank.
Maybe I should have said that.
I want to close by thanking one person. I want to thank, obviously the whole crew, but Michael Batnick really held me down.
Aw.
I was away for 7 days. This kid
Yep.
did 12 podcasts by himself. He had 500 guests on Tuesday night. He had his own Black Sabbath
Yes, he
farewell
did.
tour. It was pretty epic. So thank you, my friend. I appreciate it.
Oh, thank you.
You're never going to get a chance to do that again because you were too good and I got a little nervous. All right. That's it from us, guys. Thanks for watching. Thanks for listening. Shout out to the boys for joining us, and we'll see you next time. Have a great weekend.